Welcome to today's Explainer, where we're unpacking a truly fascinating situation unfolding right now in the financial world. We are looking at why Australia's most iconic company, the Commonwealth Bank of Australia, is flashing a massive sell signal to analysts despite reporting absolutely record-breaking numbers. This stock is a cornerstone of so many investment portfolios, a true dividend powerhouse, and yet there is a serious mystery hiding just beneath the surface of their latest earnings report. Okay, let's dive right into this by looking at Commonwealth Bank's incredible headline number. They just reported a record full-year cash profit of almost 11 billion Australian dollars. 11 billion. The CEO, Matt Comyn, even came out and described this performance as one where the bank grew without sacrificing margin. By all traditional metrics, this is just a phenomenal outcome. The fundamentals look incredibly strong, and the bank appears to be firing on all cylinders.
But here is the kicker. Since those stellar results were announced to the public, CBA has seen approximately $15 billion completely wiped off its market capitalization. The stock is currently trading near $167, but the average analyst price target is drastically lower, sitting just under $123.
So how does a record profit actually trigger a sell signal? This right here sets up the central paradox of our explainer today. I mean, how can a company deliver such stellar, record-breaking fundamentals while the market and financial analysts are practically screaming at investors to sell? It feels completely counterintuitive, doesn't it? If the business is making more money than ever, shouldn't the stock be flying high? To understand why it's not, we have to look a little closer at the mechanics of this specific market moment. That brings us to Section 1, the perfect alibi, firing on all cylinders. To solve this mystery, we first need to objectively look at why CBA looks so bulletproof on paper and give credit exactly where it's due.
Just look at what they are achieving. They're actually taking market share across all 5 of their key domestic products, including home loans, deposits, and business lending, growing at or above the system average for the first time in 15 years. Add to that, they're investing heavily in digital and AI, bringing in new executive talent like a new group CIO and CTO to drive long-term efficiency. They have a totally bulletproof balance sheet, highlighted by a recent $300 million share buyback and very favorable access to global debt markets. And for the income investors, they are rewarding you with a total dividend of over $5 per share, giving a solid 3% fully franked yield.
But that brings us to Section 2, the twist, the valuation disconnect. Because if the business is actually that strong, the falling share price really only comes down to one single word: valuation.
Now take a look at this stark contrast. The current share price means CBA is demanding a 26 times forward earnings multiple. To put that into perspective for you, the broader Australian market typically trades at about 16 to 18 times earnings. This means investors are paying a massive premium to own this stock right now. The market has literally priced CBA for absolute perfection. There is zero room for error.
When we map out the current share price of roughly $167 against independent research house Morningstar's fair value estimate of just $108, the reality becomes glaringly obvious. It reveals a nearly 60% premium over their intrinsic value estimate. And hey, even if we look at the consensus from the most bullish analysts on the street, their 12-month price target is still only $122.75.
So the crucial point here is that even the most optimistic market watchers see a potential downside of 31% from current levels. Think about that for a second. You are holding a stock that the most positive experts believe is overpriced by nearly a third. But what could actually trigger that kind of severe drop? Let's move to Section 3, the storm, macro headwinds approaching. We cannot analyze Commonwealth Bank in a vacuum.
Economic reality is biting hard. As this timeline from CBA's own economics team shows, the Reserve Bank of Australia isn't expected to cut interest rates anytime soon. In fact, due to persistent inflation and global geopolitical risks, they are forecasting rates to stay on hold through 2024, 2025, and even 2026. Rate cuts aren't actually expected until 2027. This maintains a very high-cost environment for households, which inevitably leads to creeping mortgage arrears, slowing spending, and weakening business confidence.
Because rates are staying higher for longer, the bank's core engine is cooling rapidly. The housing market is simply slowing down. Since May, overall home loan applications have seen a 15% decline. But look at property investor applications. They are down a staggering 28%. The bank's own management has admitted that high interest rates are slowing the economy, and housing credit growth forecasts have been severely downgraded.
Furthermore, intensifying competition in this shrinking borrower pool means their profitability is getting squeezed. In a slowing economy, bad debts rise and banks have to fight much harder for fewer loans. Despite the CEO stating they grew without sacrificing margin, the reported net interest margin, which is a difference between what they pay for deposits and what they charge for loans, actually fell by 3 basis points to 2.05%. And with rates holding steady for the foreseeable future, that pressure is unlikely to ease up.
And while technology and efficiency are always pitched as their future, there are hidden risks there too. The CEO himself recently highlighted the unpredictable rise in costs of scaling artificial intelligence. He specifically pointed out the very real challenge of managing AI output to avoid what he amusingly called work slop. It's a slightly humorous term, sure, but it points to a serious issue. The bank is pouring massive amounts of money into AI, but the returns on that investment remain totally uncertain, and the operational costs could quickly spiral.
So how do we reconcile all of this? It's time for Section 4, the verdict, weighing bull versus bear. As an investor, you have to carefully weigh these competing realities. Synthesizing the analyst consensus perfectly. On the bull side, you're looking at a dominant market position, a wide moat, a sustainable fully franked dividend over $5, and a projected 5% long-term earnings growth. But on the bear side, you have to weigh that against a severely inflated 26 times valuation, a deteriorating macro environment with cooling housing and rising arrears, and a highly unfavorable risk-reward ratio featuring a 31% downside risk. Ultimately, analysts view this as a textbook scenario of overpaying for quality. Sure, the company is fundamentally excellent. No one is denying that. But when you buy at too high a premium, your total return over the next 12 to 18 months could be deeply negative. That modest 3% dividend yield you are chasing could easily and very quickly be entirely wiped out by a much larger 30% capital correction. The overarching takeaway from the market experts is crystal clear. Stay away for now. If you're a long-term holder sitting on massive gains, you might ride it out. But for new buyers, the safest position is to watch from the sidelines until the stock reprices to a more realistic $100 to $120 range. The numbers simply do not add up for new investors today.
Which leaves us with one final, crucial question for you to consider about your own portfolio and really your broader investment philosophy. Is a great company ever worth buying at a terrible price?